Welcome back to the Deep Dive. Today we are doing something a little different. Usually we're looking at big trends or specific companies or these huge macro ideas.
The big picture stuff.
The big picture stuff, exactly. But today we're going to look at the machinery itself, the actual, nuts and bolts of how investment funds really work.
Down in the engine room.
Right. And I have to be honest with you, when I first looked at the source material for today, it's Chapter 10 of the NISM series V-A certification, my first instinct was to just run for the hills.
It does have that textbook look, doesn't it? A bit dry on the surface.
It looks exactly like a textbook. It's titled Risk, Return, and Performance of Funds. And look, usually when I see a chapter title like that, my brain immediately thinks, okay, boring compliance stuff. Let's just skip to the part where we talk about making millions.
Right, the fun part.
But you flagged this. You said this is actually one of the most important documents we've covered in months.
Oh.
So what?
Because this is the detective kit. I really believe that. Everyone, and I mean everyone, focuses on the return. We all want to look at a fund's fact sheet, see that big green number, and start daydreaming about the vacation house.
Healthy. Absolutely.
But the return is just the result. It's if we want to get a bit noir with it, it's the body at the crime scene.
Okay, I like where this is going. So if the return is the body, what's the rest?
Then risk is the weapon, the motive, and the opportunity all rolled into one. You cannot understand how that return happened or, more importantly, if it's ever going to happen again, without understanding the risks that were taken to get it.
So it's about repeatability.
It's all about that. And frankly, most investors, even smart ones, are flying blind. They look at past performance and they treat it like it's a guarantee for the future.
Which every document says it isn't.
In the smallest possible font, yes. But this chapter tells us that past performance is barely even a hint. The real story, the predictive story, is hidden in the risk metrics.
So our mission today, then, is to stop just looking at the shiny hood of the car and to actually get our hands dirty and strip the engine down. We're going to decode the jargon, beta, standard deviation, modified duration, and figure out what it actually means for our money.
Precisely. We're going to move from asking, what is this definition, to asking, why does this specific thing ruin my portfolio if I ignore it?
That's a much better question.
Yeah.
So let's start with the absolute basics, because the source material makes a distinction right at the very beginning that I think most people, myself included, probably miss.
I know the one you mean.
We tend to think of a mutual fund like it's a bank account or fixed deposit. I put money in, the bank holds it, the bank is responsible, the bank pays me. But the text calls a mutual fund a pass-through vehicle. That sounds legally very specific and distinct.
It is a massive, massive legal and financial distinction. It's foundational. If you put your money in a bank fixed deposit, the bank is your counterparty. They owe you the money.
Right. The contract is with me and the bank.
Exactly. If the bank goes out and makes a bunch of terrible loans and loses a fortune, that's the bank's problem. It's on their balance sheet. They still owe you your principal and your interest. The risk fundamentally sits with the bank.
They act as a buffer, a shock absorber.
A perfect way to put it. In a mutual fund, there is no buffer. There is no shock absorber. The fund is just a conduit. Think of it like a pipe.
Okay.
You put your money in one end of the pipe. The fund manager takes that money and buys assets, stocks, bonds, whatever they are, and those assets sit in a trust. If those assets go down in value,
the value of my investment goes down.
Immediately. The risk passes right through that pipe and lands directly in your lap. There is no institution in the middle taking the hit for you.
So the fund manager isn't a bodyguard for my money. They're more like a personal shopper.
That's a crude way to put it, but it's not wrong. They are a professional shopper who's been given your credit card, and if they buy spoiled milk, you're the one who ends up with a sour taste in your mouth.
Right.
And that brings us right to the core of this whole chapter. Actually defining what risk is. The text is smart about this. It doesn't just say risk is the chance you'll lose money. It breaks it down into two big categories. You've got the general environment, think of it like the weather, and then you've got the specific vehicle risks.
Like the car you're driving in that weather.
Exactly. The weather affects everyone on the road, but the quality of your car determines how well you handle it.
Let's talk about the weather first then. The general risk factors. The very first one the source lists is liquidity risk. Now, I know what liquidity is in a broad sense. It's about having cash, being able to sell things, but the text seems to imply something more menacing here.
This is where people get really badly burned, especially in a crisis.
Yeah.
In a normal, calm market, everything looks liquid. It all seems fine.
Right. You see a stock price on your screen, say it's 100 rupees. You just assume, okay, I can sell my shares and get 100 rupees for each one.
You assume there's a deep market of buyers waiting. Liquidity risk is that gut-wrenching realization that the price on the screen is purely theoretical until you actually click sell and find a real live buyer on the other side.
So the risk isn't necessarily that the price drops from 100 to 90. The risk is that the market just disappears.
Or it thins out so dramatically that it might as well have disappeared. Imagine you own a corporate bond from a smaller company. On paper, it's worth a lot of money, but it only trades a few times a week.
Okay.
Suddenly you need cash. You have an emergency. You go to sell your bond. You're looking for a buyer at the last traded price of 100. But there are no bids at 100. No one at 95. No one at 90. There's one guy, a lowball offer, sitting there at 80.
And if I need the money, I have to take it.
You have to take the 80. You just lost 20% of your capital, not because the company was failing or the asset was bad, but simply because the market liquidity wasn't there when you needed it.
It's like owning a rare, expensive painting during a recession. It might be worth $1 million in an auction catalog, but if the only person in the room with a checkbook offers you 10 grand.
Then on that day, it's worth 10 grand. And the text makes a key point that this is a specific danger in money market securities.
Which we all think of as being ultra safe, like cash.
We assume they are. But if the credit markets freeze up, which they absolutely did in 2008 and had a wobble in 2020, that liquidity can vanish overnight. You own the paper, but you can't spend paper. You need cash.
That's a sobering thought. Okay, the next general risk, this is the one I confess I still struggle with sometimes, interest rate risk. The text calls this the teeter-totter relationship. Rates go up, bond prices go down.
This is without a doubt the single most important concept for anyone who invests in debt funds. And you're right, it is completely counterintuitive for most people.
It really is. My brain just naturally goes, higher interest rates are good. That means I earn more interest on my money. So my investment should be worth more, not less. Why does the text say I lose money?
Because you have to separate the old bond you already own from the new bond that's being issued today. Let's just play this out.
Okay, walk me through it.
You go out today and you buy a 10-year government bond. It costs you 100 rupees and it pays a 5% interest coupon. You're happy. You're set to get your 5 rupees a year for the next 10 years.
Simple enough. I have my 5% bond.
Tomorrow, the central bank holds a meeting. They're worried about inflation getting out of control, so they decide to hike interest rates. Now, the government starts issuing new 10-year bonds. But these new ones pay 7%.
Okay, so now obviously I'd rather have the 7% one.
Of course you would. But you've already spent your 100 rupees on the old 5% bond. Now, let's say you decide you want to sell your old bond so you can free up cash to buy the shiny new one. You go to the secondary market. You stand there waving your 5% bond in the air. Who is going to buy it from you for 100 rupees?
No one. Why on earth would they? They could just go directly to the source and buy a brand new 7% bond for the same 100 rupees. My bond is obsolete.
It's obsolete at that price. Bingo. So, to convince someone, anyone, to buy your inferior 5% bond, you have to put it on sale. You have to lower the price to, say, 95 rupees or 90 or whatever the number is, until the math works out that the new buyer gets a total return equivalent to the new 7% bonds.
So the market value, the capital value of my bond, just crashes.
Immediately, in real time. That is interest rate risk. When prevailing market rates rise, the capital value of existing lower rate bonds falls. And since mutual funds have to value their portfolios every single day, it's called mark to market, if interest rates spike, the net asset value, the NAV of your debt fund, drops. You'll literally see a negative return for that day.
That finally makes sense. You're holding the bag of old, low-yield paper. But the text mentions another side to this coin, reinvestment risk. This one at first glance sounds like a luxury problem. Oh no, I have so much money coming back, I have to reinvest it.
It sounds like a great problem to have, but it can be an absolute wealth destroyer over time, especially for people in retirement. Imagine the exact opposite scenario. You are smart or lucky, and you own a bond portfolio that's paying you a juicy 8%.
I feel great about myself.
You feel like a genius, but then the economy slows down and the central bank starts slashing rates to stimulate growth. Suddenly, new bonds are only being issued at 4%.
Okay, so my 8% bond is now worth a lot more, right? The price goes up?
The capital price goes up, yes. That's the teeter-totter working in your favor.
Yeah.
But what happens when that bond matures or when it pays you that interest coupon every 6 months? You get a chunk of cash back.
Right.
Now you have to put that cash back to work. But where can you put it? The entire market is only offering 4%.
I can't find 8% anywhere. It's gone.
It's gone. Your income stream collapses.
Mhm.
This is a massive risk for retirees. They build a portfolio based on, say, 7% yields to fund their lifestyle. Rates fall, their bonds mature one by one, and suddenly they can't generate the same income without taking on huge amounts of new risk, maybe in stocks or lower quality bonds. It effectively forces you to start eating into your capital to maintain your lifestyle.
So it's a pincer movement. Interest rate risk hurts your capital value today if rates go up. Reinvestment risk hurts your future income stream if rates go down.
That is a brilliant way to summarize it. It's a financial pincer movement, and you rarely, if ever, escape both at the same time.
Okay, what about the broader environment? The text lumps political and economic risk together. This feels a bit generic. Bad things can
It
happen.
does feel generic until it happens directly to your portfolio. Think about something like fiscal deficits. If a government is spending way more than it earns, it has to borrow more and more money.
Issuing more bonds.
Exactly. That huge supply of new bonds can drive up interest rates for everyone. That's bad for your existing bonds. It can also lead to inflation, which erodes the real value of your returns. Or think about a sudden policy change. A government decides overnight to slap a huge windfall tax on a certain sector or ban an export. Stocks in that sector can tank 20% in a day. That wasn't a business failure. It was a pure political risk materializing.
And linked directly to that is foreign currency risk. I feel like this is becoming so much more relevant now that so many Indian investors are finally buying U.S. tech funds or global funds.
It is, and it's a double-edged sword that people consistently forget to account for. Let's use a simple example.
Yeah.
You buy a U.S.-focused mutual fund. You're now a proud owner of Apple, Microsoft, Google. Over the course of a year, those stocks do great. They go up by 10% in dollar terms on the New York Stock Exchange. You feel like a genius.
10% is a solid return. I'd take it.
But over that same year, let's say the Indian economy does really well and the rupee strengthens against the US dollar. Maybe the rupee goes from 83 to a dollar down to 75 to a dollar. That's roughly a 10% appreciation of the rupee.
Wait, if the rupee gets stronger, isn't that a good thing for India?
It's good for India as a country, perhaps, but it's very bad for your specific US investment because your investment is denominated in dollars. When the fund manager in India calculates the NAV, they have to convert those dollar-denominated assets back into rupees.
And now each dollar buys fewer rupees.
A lot fewer. Your 10% gain from the stocks is completely wiped out by the 10% loss from the currency conversion. Your net return is zero, maybe even negative after expenses.
That is absolutely heartbreaking. So I need to be watching the currency charts just as much as the stock charts if I'm investing globally.
You can't separate them. You are, whether you intend to or not, taking a position on the currency pair. It's an inherent part of the investment.
Okay, so that's the weather report, the macro environment. Let's look at the vehicles themselves. The text splits this into equity and debt. Now, we all know equity is risky, prices bounce around every day, but the text also mentions something called settlement risk. Is this still a real thing? I thought everything was digital and instantaneous now.
It's largely digital, which has reduced the risk enormously, but it hasn't eliminated it. Settlement risk is, at its core, counterparty risk. It's the risk that the trade happens, but the actual exchange of goods and money for shares fails.
So if I pay the money, but they don't deliver the shares?
Or vice versa. The fund delivers the shares, but the buyer's money doesn't arrive. In modern markets, you have clearing corporations that act as a central counterparty to prevent this. But in times of extreme market stress, or with smaller, less capitalized brokers, or in off-market transactions, it can still happen. The system isn't magic, it's a chain of promises. If one link in that chain breaks, the trade can fail.
The text also throws in a couple of terms that sound like they're straight out of a Wall Street movie. Securities lending and short selling. Why would a normal mutual fund, which I think of as a long-term buy-and-hold investment, be doing this stuff?
To try and squeeze out a little bit of extra return, a few basis points here and there, securities lending is basically the fund renting out the shares it owns for the long term.
Renting them out.
Yeah. Let's say the fund owns 1 million shares of Reliance. They're not planning to sell them anytime soon. So they can lend those shares to a trader, typically a hedge fund, who wants to short sell them. That trader pays the fund a fee for the loan. That fee gets added to the fund's return.
So it's free money.
There is no free money in finance. There's always a catch. The risk is that the borrower, the trader who took the shares, goes bankrupt and can't return them. Now, you have collateral, of course, but it's a hassle, there's legal risk, and it's a complication you wouldn't otherwise have.
And short selling.
That's the fund itself, betting that a stock's price will fall. The specific risk here, which can be catastrophic, is a short squeeze or just general liquidity. If you bet a stock will fall from 100 to 80 and instead it doubles to 200,
You lose your shirt.
you lose your shirt, your pants, and the house you live in. Losses when you buy a stock are capped at 100%. The stock can only go to zero. Losses when you short a stock are theoretically infinite because there's no limit to how high a stock price can go. Now, mutual funds have very strict regulatory limits on this, but the risk is structurally different and far more dangerous than just buying stocks.
Okay, let's pivot to the debt-specific risks. We've covered interest rate risk, which is the big market force, the weather, but the specific risk to an individual bond is credit risk.
This is the big one. This is the simple primal question: will they pay me back? It's the fundamental difference between lending your money to the government of India, which can print money to pay you back, and lending to a startup that's burning through cash every month.
And this is where the rating agencies come in, right? The text mentions AAA versus AA.
Yes, AAA is the gold standard, the highest possible rating for safety. 8A is still very good, but considered slightly riskier. The further down the alphabet you go, A, BBB, BB, the higher the statistical chance of default.
Default meaning they just miss a payment.
They miss an interest payment or they fail to return the principal at maturity. But there's a more subtle risk here that the text calls spread risk.
Explain that one. It sounds technical.
It is, but it's crucial. Imagine you buy a corporate bond rated AA. At the time you buy it, it pays 2% more than a super safe government bond of the same maturity. That extra 2% is the credit spread. It's your danger pay for taking on the credit risk.
Okay, the 2% spread.
Now a year passes. The company hasn't defaulted. They're still paying their interest on time. But the broader economy gets a bit shaky. Investors become more nervous and risk-averse. They look at AA-rated bonds and they decide that a 2% danger pay just isn't enough anymore. They want 4% to compensate for the perceived risk.
So the market demands a wider spread.
The spread widens. And even though benchmark government interest rates might be completely stable, the price of your specific corporate bond will crash because the market is now demanding a higher yield from it. You lose capital value without a default even happening.
That's nasty. It's like the neighborhood your house is in gets a bad reputation. Your house is perfectly fine, but its market value drops anyway.
That is a perfect analogy.
Okay, we've surveyed the landscape of risks. This is the stuff that can go wrong.
Yeah.
Now I want to get into the analysis part of the chapter, the engine room, as you called it. Let's start with equity. The text dives right into fundamental analysis. This feels like the classic Warren Buffett, Graham and Dodd stuff.
It is. It's the attempt to determine the intrinsic value of a business based on its actual, tangible reality, not just the hype or the stock chart. And the text lists the key gauges on the dashboard: EPS, PE ratio, book value.
Let's run through these, but practically, not just definitions. EPS, earnings per share.
It's the net profit of the company divided by the total number of outstanding shares. This is the fuel for the engine. If a company isn't generating earnings, or more importantly, growing its earnings, then eventually the stock price has no fundamental support. It's just subject to gravity.
But the EPS number by itself doesn't tell me if the stock is cheap or expensive, does it? That's where the PE ratio comes in.
Exactly. The price-to-earnings ratio. This asks the question: how many rupees is the market willing to pay today for every 1 rupee of the company's current earnings? And this is where psychology meets math. A really high PE ratio, say 50, 60, or even 100, means the market is wildly optimistic.
They're expecting massive growth.
They're not just expecting it, they're paying for it in advance. They expect earnings to double or triple in the near future to justify that price.
So a high PE is inherently risky then.
It's what we call a growth risk. You are paying today for a future that hasn't happened yet. If that company stumbles, if earnings only grow by 10% instead of the expected 50%, the stock price won't just dip a little, it will collapse because that entire premium of optimism just evaporates into thin air.
And the opposite of that is a low PE. That's value investing, right?
It's the classic value style. A low PE, say 8 or 10, means the market is pessimistic or maybe just indifferent. The story isn't exciting. The bet you're making is that the market is wrong. You're trying to buy $1 of earnings for 50 cents.
What's the risk there?
The risk is that you've fallen into a value trap. The market might be pessimistic for a very good reason. Maybe the company's technology is obsolete or its business is slowly dying.
So the fund manager has to make a choice, a stylistic choice. Am I a growth investor, chasing that high PE, high growth dream? Or am I a value investor digging through the bargain bin looking for hidden gems?
Precisely. And the text makes a crucial point here. To beat the benchmark index, the manager must take a position. They have to be different. If the benchmark index is 50% tech stocks and you as a manager just buy 50% tech stocks, you are destined to perform exactly like the benchmark minus your fees.
You're just tracking it.
To win, you have to make an active bet. You have to say, I believe tech is overvalued, so I'm only going to own 20%. And then you have to be right.
But if you're wrong, if tech goes on another 5-year tear,
Then you underperform significantly and your investors get angry. That is the fundamental risk and reward of active management.
let's move to the debt engine room. This is where the math in the text starts to get a bit dense. We have terms like yield to maturity, or YTM, and holding period return, or HPR. Why do we need two different ways to say return?
Because they measure two completely different intentions, two different scenarios. YTM is what I'd call the marry the bond metric.
Marry the bond.
Yes. If I buy this bond today at a price of 95 rupees and I solemnly swear to hold it until it matures in 10 years through sickness and in health, YTM tells me exactly what my total annualized return will be. It locks in all the interest payments and the final principal repayment into one single annualized number. It's a promise based on holding to the very end.
Okay, that's clear. So what's HPR?
HBR is the date the bond metric. I buy it today, but I'm making no long-term commitment. I might sell it next year if a better opportunity comes along. My return in that scenario, my HBR, will be the interest I earned for that 1 year plus whatever capital gain or loss I make on the sale price.
And the sale price will depend on what interest rates have done in that year.
Exactly. HPR is reality for most investors. YPM is a projection, a hypothetical based on never selling.
And since a mutual fund is almost never holding every single one of its bonds to maturity, they're constantly buying and selling, it's really the HPR that drives the fund's quarterly performance, isn't it?
That's it. And that HPR, that change in price, is driven by a concept called duration.
Modified duration. This is the term that makes everyone's eyes glaze over. The text treats it as an absolutely critical risk measure for debt funds.
Think of duration as the sensitivity dial on an amplifier. Or a lever. A longer lever gives you more force. If a bond fund's fact sheet says it has a modified duration of 5 years, it's giving you a simple rule of thumb.
What's the rule?
It means that for every 1% change in interest rates, the fund's NAV, its price, will move by roughly 5% in the opposite direction.
So it's a multiplier for interest rate risk.
It is the multiplier. If you buy a fund with a duration of 10 years, a sudden 1% rate hike by the central bank will crash your portfolio's value by about 10% instantly. But if your fund's duration is only 0.5 years, that same 1% rate hike only causes a tiny 0.5% dip.
This is the real so what for the listener, isn't it? If I'm nervous that the RBI is going to raise interest rates, I shouldn't just look at the yield a fund is offering. I need to find the duration.
100%. You will see debt funds out there offering a juicy-looking return, but when you dig into the fact sheet, it has a duration of 8 or 9 years. You are not getting that return for free. You are taking on massive interest rate risk. You are essentially betting the farm that rates won't rise.
And if I want safety,
You look for low duration. That's what liquid funds and ultra short-term funds are. They have very low duration, so they are much less sensitive to those rate changes.
okay, this brings us perfectly to section 4 of the text, the philosophy of risk. The source draws a big, bold line in the sand between systematic and unsystematic risk. This feels really important.
It is the holy grail of modern portfolio theory. It's the foundational idea. The entire chapter, in a way, boils down to this distinction. It asks one simple question. What risks can you get rid of for free, and what risks are you stuck with, the ones you must be paid to take?
Unsystematic risk is the stuff we can get rid of then.
Yes. Unsystematic simply means specific or idiosyncratic. It's a risk that applies to just one company or maybe one specific industry. A fire at a key factory, a major labor strike, a CEO getting caught in a scandal and running off with the company's cash.
Things that are terrible for that one company but don't affect anyone else.
Exactly. And the cure for this is simple, and it's free. It's diversification.
Don't put all your eggs in one basket.
Right. If you own only one stock and its factory burns down, you are ruined. If you own 50 different stocks across 10 different industries, a factory fire in one of them is just a small blip. It's a rounding error in your total portfolio. You have effectively diversified away that specific unsystematic risk.
Okay, that makes perfect sense. So what's left? What is systematic risk?
That's the risk that hits the entire basket. It's the risk of the whole system. War, a global pandemic, a deep recession, a surprise sharp spike in global interest rates.
The big, scary macro stuff.
The stuff that, when it happens, causes everything to fall at once. Good stocks fall, bad stocks fall, real estate falls, corporate bonds fall.
So I can hold 50 stocks or 500 stocks or 5,000 stocks, but if a war starts, they're all probably going to go down.
Correct. In a panic, correlation between assets approaches 1. Everything moves together in lockstep down. You cannot diversify away systematic risk by just adding more stocks from the same market.
And this leads directly to the CAPM theory mentioned in the text, the capital asset pricing model.
Yeah.
It's intimidating.
The name is intimidating, but the idea is simple and it's kind of brutal. CAPM effectively says this: the market is smart. It knows that any investor can easily diversify away unsystematic risk just by buying a simple index fund. So the market will not pay you a premium for taking on that unsystematic risk.
Wait, run that by me again. If I take a big risk and buy a single speculative small cap stock, shouldn't I expect a higher potential return for taking that risk?
CAPM says no, because you could have just bought the whole index and gotten the market return with much less specific risk. If you choose to take the concentrated risk of a single stock, that's your gamble. That's on you. The theory says the market only rewards you for taking on the risk you can't get rid of, the systematic risk.
So it only pays you for being exposed to the whole market's volatility.
It rewards you for having skin in the game, for exposing your capital to the broad market's ups and downs, which is measured by beta. It does not give you extra points for gambling on a specific horse in the race.
That is a fundamental blow to the ego of every stock picker out there.
It really is. It implies that unless you have some genuine special skill, what we call alpha, you're probably better off just buying the whole market and calling it a day.
Wow. Okay, let's move to the scoreboard then. Section 5. Measuring returns. The text spends a lot of time on CAGR, the compound annual growth rate. We see this number everywhere, 15% CAGR over 5 years. But it points out a hidden trap here, something called the reinvestment assumption. I want to drill into this because I'm pretty sure I've been calculating my own returns wrong for years.
Most people do. It's a very common misunderstanding. Let's do a quick thought experiment from the text. You invest 100 rupees in a mutual fund. The NAV is 10 rupees per unit, so you now own 10 units.
Got it. 100 rupees, 10 units at NAV 10.
Over the course of the year, the fund does well, makes a profit, and decides to declare a dividend of 2 rupees per unit. You own 10 units, so you get a check in the mail for 20 rupees.
Nice. Free money for dinner.
You take that 20 rupees and you go buy a nice dinner. Meanwhile, because the fund paid that money out, its assets have decreased. The NAV of the fund drops by the dividend amount, so the NAV is now roughly 8 rupees, ignoring any other market moves for simplicity.
Okay, makes sense.
Here's the catch. The fund's fact sheet, when it calculates its official CAGR, assumes you did not go out for dinner.
What does it assume I did?
It assumes you are a perfect, rational compounding machine. It assumes you took that 20 rupee dividend payment and immediately, on that same day, used it to buy more units of the fund at the new, lower NAV of 8.
So instead of 10 units, I'd now have my original 10 plus another 2.5 units I bought with the dividend. I'd have 12.5 units working for me next year.
Exactly. You would have more units and the compounding would accelerate. If you took the cash out and spent it, you broke the compounding chain. Your personal return will be significantly lower than the officially reported CAGR on the document. CTR is only true if you reinvest every single paisa.
That is a huge insight. So if I'm an investor who takes dividends as income, I can't fairly compare my portfolio's performance to the benchmark index because the index's performance also assumes all dividends are reinvested.
Precisely. And that's why we now have the TRI, the Total Return Index.
Yes, the text mentions SEBI mandating the use of TRI for benchmarking.
This was a big and very important change. In the old days, many funds, well, they cheated a little bit. They would compare their own return, which included both price changes and dividends, to the benchmark's price index, which only included price changes.
So the benchmark always looked lower than it really was because it was ignoring all the dividends its companies were paying out.
Right. It's like a runner giving themselves a 10-meter head start in a 100-meter race. It was an easy bar to clear. SEBI stepped in and said, no more. You have to compare your total return to the benchmark's total return index, which includes the impact of reinvesting all those dividends.
It leveled the playing field.
It made the race fair, and suddenly a lot of funds that claim to be outperforming the market look decidedly average.
Good for the regulator. Now let's get to the scary math. Section 6, the statistical toolkit. Variance, standard deviation, beta. Let's start with standard deviation. The text defines it as a measure of fluctuation from the average return.
Let's forget the textbook definition. Let's just call it the sleep test.
The sleep test,
All right.
like that.
Standard deviation, or SD, measures how wildly the fund's returns swing around its average. Let's say a fund has an average return of 12%, which sounds great, but it also has a standard deviation of 20%.
What does that mean, practically?
It means that in any given year, while the average might be 12%, the return could easily be 12 plus 20, so plus 32%, or 12 minus 20, which is minus 8%. And it could be even wider than that.
That's a massive range. That's a roller coaster.
It's a huge roller coaster. Now, contrast that with another fund that also has a 12% average return, but its standard deviation is only 5%. That fund's typical returns will be in a much tighter band, maybe from 7% to 17%. It's a much smoother ride.
So if I'm looking at a fund fact sheet and I see a high SD number, the real question I need to ask myself is, can I emotionally handle seeing my portfolio down 20% in a single year or even a month?
Yes, because the math of that standard deviation tells you it will happen at some point. It's not a bug. It's a feature of that fund's strategy. If you see that drop, panic, and sell at the bottom, you have officially failed the sleep test.
Okay. What about beta? The text says it measures sensitivity to the market. How is that different from standard deviation?
Standard deviation measures total volatility from all sources. Beta isolates one specific source of volatility, the market itself, or systematic risk. Beta is the amplifier. The market as a whole, the Nifty 50, for example, has a beta of exactly 1. If you buy a Nifty 50 index fund, your beta is 1.
But I want to be more aggressive than the market?
You look for a fund with a beta greater than 1. Say you buy a fund with a beta of 1.5. If the market goes up 10%, your fund should, on average, go up 15%. You feel like an absolute genius.
But there's always a but.
The but is that the amplifier works in both directions. If the market drops by 10%, you drop by 15%. That leverage cuts both ways, and it hurts a lot more on the way down. Beta is a pure measure of how much systematic market risk you are taking on.
So is a low beta always safer?
It's more defensive. A beta of, say, 0.7 means the fund tends to participate in only 70% of the market's moves. In a big market crash, you'll lose less than everyone else. But in a raging bull market, you'll lag behind.
So it's about matching your personality. If I'm a retiree who values capital preservation, maybe I want a low beta. If I'm 25 and aggressive, maybe I want a high beta to maximize gains in a good market.
Exactly. But you have to know what you are buying. You can't buy a beta 1.5 fund and then complain to your advisor that it's too volatile. You specifically paid for that extra volatility.
The text also circles back to debt risks here, with the credit rating profile and a very important concept, concentration risk. It uses an example, debenture M.
This is such a critical and often overlooked cautionary tale. Concentration risk in a debt fund is deadly. In an equity fund, if one of your 50 stocks goes to zero, it hurts, but you survive. In a debt fund, if one of your main bond holdings defaults, it can freeze the entire fund.
Wait, freeze the whole fund?
Because of our very first point, liquidity,
Right.
or the lack of it. If debenture M, which makes up 8% of your fund's portfolio, suddenly defaults, nobody in the market wants to buy it from the fund manager at any price. It's toxic.
So it's stuck in the portfolio.
It's stuck. But at the same time, investors hear the news of the default, they panic, and they start redeeming their units. They're asking for their money back now.
So the manager has to sell the good bonds, the liquid government bonds, to raise cash to pay the investors who are running for the exit.
Leaving the loyal investors who stayed behind holding a shrinking bag that contains a much higher percentage of the toxic garbage, it's a death spiral.
That sounds like a complete disaster.
It is, and it has happened. That's precisely why the regulator, SEBI, introduced the concept of segregated portfolios, which the text covers.
The side pocket mechanism.
Right. It's like a medical quarantine for a bad asset. If debenture M goes bad, the fund manager is allowed to split the fund into two. Portfolio A contains all the good, healthy, liquid assets. Portfolio B contains only the toxic, defaulted debenture M.
And what happens to me as an investor?
You get units in both portfolios. You can continue to buy and sell your units in Portfolio A normally. It can function again. Portfolio B is frozen, locked away. If, down the line, the fund manager manages to recover any money from the defaulted company, that money is distributed to the holders of the Portfolio B units.
So it stops the panic from contaminating the healthy part of the portfolio. It stops the contagion.
Exactly. It protects the investors who don't panic and run. It's a crucial protection mechanism.
Speaking of protection, we have the riskometer. We see this little speedometer-style dial on every single fund document. Is it actually useful, or is it just regulatory wallpaper?
It used to be wallpaper. Honestly, it was static. A fund would classify itself as moderately high risk and just leave that label there for 10 years, regardless of what it was actually buying. But now SEBI mandates that it must be dynamic.
Dynamic in what way?
It has to be recalculated every single month based on the actual securities in the portfolio at that time. So if a fund manager who runs a moderate risk fund suddenly decides to sell all their blue chips and buy a bunch of risky, high-beta small-cap stocks,
The needle has to move.
the needle on the riskometer must physically move to very high on the next month's fact sheet. It's a real-time warning signal.
So I should actually be looking at that little dial every month on my fund statements.
You absolutely should. It's one of the simplest and most effective tools you have. If you bought a fund that was in the green low-risk zone and you suddenly see the dial has shifted to orange or red, the fund manager has changed the strategy. You need to ask why and decide if you're still comfortable with that.
We've covered a massive amount of ground here, from the basic machinery of the fund vehicle to the math of risk and the protection offered by regulators. But I want to try and land this plane with some really practical, actionable advice for the listener. We've decoded all these terms. How do we actually use them to make a better decision?
It all comes down to one word.
Yep.
Matching.
Matching what to what?
Matching the risk statistics of the fund to your own personal timeline. This is the ultimate so what.
Give me a clear example.
Okay. Let's say you are investing for a long-term goal, 10 or 15 years away, your retirement, or a child's college education. In that scenario, you can afford to ignore the short-term standard deviation to some extent.
Because time smooths out the bumps.
Time heals volatility. The historical probability of losing money in a diversified equity portfolio over a 10-year period is very, very low. You can afford to own a high beta fund. You can afford the roller coaster ride because you have time to recover from the dips.
But what if I need the money in 2 years for a down payment on a house?
Then standard deviation is your mortal enemy. You simply cannot afford a 20% or 30% drop just before you need to write that check. You need low standard deviation. For debt, you need low duration. You need to be boring. Your priority is capital preservation, not high returns.
So risk isn't just an inherent property of the fund itself. It's a relationship between the fund's characteristics and my personal timeline.
That is the deepest and most important insight of the day. A high-risk equity fund can become a relatively low-risk proposition if you hold it for 20 years. And a safe government bond fund can become a very risky gamble if you have a short timeline and might be forced to sell it during a period of rising interest rates.
I promised a provocative thought at the end of this deep dive. We've talked about risk and return as two separate things, but is there a way to combine them to get a single score for a fund?
There is, and it's the ultimate metric of efficiency. It's what professionals look at. We call it risk-adjusted return.
Explain that. What does it adjust for?
Imagine two fund managers. Manager A gives you a 12% return over the last 5 years, but to get it, they gave you a heart attack. The fund had wild swings, a huge standard deviation.
Okay.
Manager B also gave you a 12% return over the same 5 years. But it was a smooth, steady, boring climb, very low standard deviation.
So on paper, the final return is identical, 12%.
Identical return, but Manager B's fund is mathematically superior. It was more efficient. It generated that 12% return using far less risk fuel. Professional investors don't just chase the highest absolute return, they chase the highest return per unit of risk taken.
That's the whole Sharpe ratio concept, isn't it?
Exactly. It's the core question. Is this fund manager actually skilled, or are they just driving recklessly fast and getting lucky so far?
I love that. Don't just look at the speedometer, which is the return. Look at the quality of the car's suspension, which is the risk.
Ideally, you want a fast car with great suspension. That's the holy grail.
Well, I certainly feel like I can look at a fund fact sheet now without getting an instant headache. We've really turned this path-through vehicle inside out.
We have, and hopefully the next time you, the listeners, see the words modified duration, you won't just turn the page. You'll actually check the number.
And check the risk out meter. Thank you for guiding us through the mechanics today. This was incredibly valuable.
My pleasure. It was fun.
And to our listeners, go check your portfolio. Run the sleep test on your own investments.